When a financial crisis hits, survival is not random. Some companies get rescued overnight. Some banks are quietly saved. Some governments receive emergency support. And others, they disappear. Not because they worked harder, not because they were smarter, but because of one invisible factor: credit. Credit decides who gets a lifeline and who gets erased. And right now, that decision matters more than ever. Because we're living in an economy addicted to borrowing. Households run on loans. Companies live on refinancing. Governments survive on rolling debt. When the system is calm, credit feels boring, routine, almost harmless. But when stress hits, credit becomes a weapon. Here's how the game actually works. At its core, credit is trust with a price. When you lend money, you're betting the borrower will survive long enough to pay you back. So lenders don't just ask, is this profitable? They ask, who must be saved if this fails? That question quietly divides the economy into two groups: the rescuable and the expendable. Let's start with banks. Big banks don't just hold deposits. They sit at the center of payment systems, lending markets, and government financing. If a major bank fails, everything freezes. ATMs stop. Payroll stalls. Markets panic. So when banks overextend and things go wrong, help arrives. Emergency lending, liquidity facilities, quiet guarantees. Not because banks are innocent, but because their collapse is unacceptable. Now compare that to a small business. If it fails, the system shrugs. No payment network breaks. No bond market panics. Credit dries up. Doors close. End of story. Same mistake, very different outcome. Not corruption. That's credit hierarchy. The same logic applies to corporations. Large corporations issue bonds held by pension funds, insurers, and banks. If they default, losses spread everywhere. So they get options: refinancing, restructuring, government-backed loans. Smaller firms don't. Their credit isn't systemic, so it isn't protected. Now look at governments. Some countries can borrow endlessly at low rates. Others face instant crisis. Why? Because global lenders believe certain governments will always be rescued. Not necessarily by markets, but by institutions. Central banks, international lenders, allies. That belief lowers borrowing costs, which increases debt, which deepens dependence. It's a feedback loop. Then there are countries without that privilege. When their debt wobbles, capital flees, collapse. Austerity follows. Same global system. Different credit status. This is where the uncomfortable math appears. In modern finance, rescues are cheaper than collapse, but only for some players. Saving a large bank may cost billions. Letting it fail could cost trillions. So the rational decision is intervention. But that logic doesn't apply equally. Rescuing households is politically messy. Rescuing small firms is inefficient. Rescuing entire populations is complicated. So the system chooses concentration over fairness. Credit flows upward. Risk flows downward. Publicly, this is framed as stability. Behind the scenes, it's damage control. And here's the irony. The more often rescues happen, the more risk-taking increases. Because those with strong credit know something important. If they fail, they won't fail alone. Policy. Cheap credit encourages leverage. Leverage creates fragility. Fragility guarantees intervention. Meanwhile, those without rescue-level credit are told to be responsible, save more, borrow less, be flexible. But flexibility doesn't protect you when the system snaps. This gap shows up clearly during tightening cycles. When interest rates rise, weak credit breaks first. Households with variable loans, firms dependent on refinancing, countries with dollar debt. Strong credit survives longer, often long enough to be saved. This is why crises feel unfair even when they're predictable. It's not that rules change, it's that they were never equal. Credit isn't just access to money, it's access to time. Time to refinance, time to restructure, time to wait for rescue. Without credit, there is no time, only deadlines. And deadlines don't negotiate. So when headlines talk about bailouts, liquidity, or stabilization, understand what's really happening. The system is protecting its load-bearing walls, not its occupants. This doesn't require villains. It doesn't require secret meetings. It's baked into how modern finance assigns value. The most dangerous thing in this system isn't debt. It's believing all debt is treated the same. Because when the next shock arrives, and it will, the question won't be who deserves saving. It will be who the system cannot afford to lose. And the uncomfortable thought to sit with is this: do you know which side of that line you're on?